Ken Shinoda, portfolio manager at DoubleLine Capital and also host of Channel 11 News for DoubleLine, which offers a webcast series providing market insights with peers and industry experts. It's really great to welcome you on my podcast. So great to see you again, Ken, and great to have you. Yeah.
Thanks for having me, Julia.
Well, of course. Well, I'm really excited to have you on the show. And I was kind of hoping we could start, Ken, with a bit of an intro, a background into, your career and also the areas that you focus on at DoubleLine.
Sure. Well, I got into the finance business, maybe by luck or chance. I was going to the University of Southern California, just down the street here. And I had a friend that was interning at Trust Company of the West, TCW, which a lot of us here at DoubleLine came from. And I ended up getting an internship there and just fell into the epicenter of the global financial crisis, which was mortgage-backed securities. And I've really been investing and analyzing mortgage-backed securities, both agency and non-agency, since the GFC. And it's been a great experience. The GFC was my master's degree in finance. Didn't need to go back to business school. When you saw what happened during that time period, it's the best way to learn is just be there in the markets. So my focus has been on fixed income, and it's, I've obviously went from an analyst into trading, into portfolio management, into asset allocation. And so now more of my time maybe is spent thinking more about the macro world and what's going on in the economy and how we can position our portfolios that are not just mortgage portfolios or broad fixed income portfolios for whatever the economic situation is that's unfolding upon us.
I love that. And I love what you said about getting that master's degree in finance during the financial crisis and the areas of focus for you within structured products. Before we get into that, let's frame up maybe a bit of the macroeconomic backdrop today. Would love to kind of get the big picture from you.
Sure. I think up until what happened with the SVB bank and the regional banks, I think the economy was a mixed picture. You had certain pockets of the economy that slowed immediately as the Fed started raising interest rates. Things like the housing market, things like the tech market were very interest rate sensitive. And then as you looked at, services were kind of holding up. People were still kind of going out and spending, a lot of pent up savings from the stimulus checks. And so parts of the economy were slowing, parts of the economy were doing okay. And this is why I think the stock market was holding up. This is why inflation was being stubborn. This is why the Fed was, continuing to raise interest rates. But what happened a couple of weeks ago with Silicon Valley Bank and spreading to, Signature Bank, First Republic, it's less about what's happening to those banks. It's more about a theme that I see that, it's funny. First Republic Bank, after the global financial crisis, that was the safe place to go, right? It was the Bank of Americas and the Citigroups of the world that were all into subprime mortgages and CDOs. And so everyone's get your money out of these banks doing all these sketchy things and move them into these super safe regional banks. They made safe loans. They didn't blow up. And so there's all this money that, sits at those regional banks. And what's going on now is I think the things with SVB has brought to the forefront of the media, and the world is so much more intertwined with Twitter and YouTube and the media these days that mom and pop are realizing, hey, my savings account at Chase is earning 50 basis points, and I can earn 4% in T-bills, and I can go earn 4+% in money markets. Why do I have my money just sitting in this savings account? And if I have my money not at Chase and I have it at XYZ regional bank, and I'm oh my God, A, I need to get my money out of these regional banks, but B, why I'll put some in Chase, but why am I not in these money markets and these T-bills and these high yielding instruments? And so there's a flight of deposits that's leaving the regional banks. Some of it's coming to the money centers, these new structurally systemic important banks, right? SIB is the new word of the week that everyone's learning about. And then some of the money is going to mutual money market mutual funds, ETFs, T-bills, and things like that. And if I'm a regional bank, I'm saying, okay, A, my deposits are fleeing. So B, let's hunker down. Let's not make any loans. And they're a huge part of lending to small business. Small business is 46% of employment in the US. Small business has really been holding the economy up. And I think this banking crisis is the catalyst to finally really tighten financial situations, and the Fed will get what they want. So I've turned way more negative on the economy over the last 3 weeks, really because of this transmission of regional bank, slowdown, deposits fleeing, and then the lending will just stop. And that's kind of what the big thing on my mind right now is that things have really changed over the last 3 weeks.
Well, a lot of change in the last 3 weeks. Can you talk a bit about how that might impact the areas that you focus on? And maybe for folks who aren't as familiar about structured products, can you kind of like frame up the universe that you focus on and how you're, I don't know if you want to even go there, but how you're thinking about making decisions, investment decisions within your universe?
Sure. Well, if you think about the US credit markets, the biggest part of it's definitely corporate credit. So these are things like investment grade corporate bonds on the high quality side. And then as you go to kind of riskier parts of the market, there's high yield, which are fixed rate, riskier below investment grade bonds, bank loans, which are floating rate loans made to companies. There's a huge direct lending market that's been created over the last decade that also makes floating rate loans to companies. And then there's everything else. And everything else is in that what we call the structured products market. A lot of it is asset-backed bonds. So that means there are bonds that are backed by either residential mortgages, those are called residential mortgage-backed securities, commercial mortgage-backed securities backed by commercial loans on things like office buildings, industrial real estate, multifamily, retail, hospitality, hotels, right? Collateralized loan obligations, which are floating rate, actively managed bonds backed by bank loans, and then ABS, which everything else falls into: credit cards, auto loans, aircraft leases, shipping container receivables, music royalty receivables. So anything that's not just your plain vanilla corporate obligation falls into this world of structured products, where we, really started kind of I would say in the 90s, but didn't pick up steam till the early 2000s. And it's a different way to get credit exposure, get an extra yield over treasuries, but you have to kind of manage the intricacies of those asset classes: housing, real estate, consumer credit, and the structures that they get put in. So we can kind of go piece by piece. Let's start off with residential real estate, which was on everybody's mind last year, everyone being worried that you're going to see some big collapse in housing, which hasn't happened, right? And the thesis behind that, for us at least, was that there's a big supply-demand story. Going into the global financial crisis, we had been building way too many homes. Anybody could get a mortgage, right? You could just walk in and not even sign and get a mortgage. So loose lending standards combined with an excess of building led to an oversupply. As housing started falling down, nobody had any money down. They had no equity. They all started, throwing the keys back to the servicer and renting the place next door for half price, right? Today, it's like the total mirror. It's almost a mirror opposite. We've got almost a record low of existing inventory for sale. Lending standards are super high. You have to put money down to buy your house. There's tons of home equity, meaning people have, prices of homes have gone up so much, people have like equity in their house. They're not going to walk away from that. And then renting the place next door is not that much cheaper. So I think that supply-demand dynamic with no supply, and then marginally you have the millennial generation coming in to buy, was my thesis on why, even though rates are higher and affordability is down, prices won't drop that much. And we're only down about 4% nationwide from the peak, which was kind of the middle of last year. So from a residential standpoint, we still have underbuilding, undersupply, and I'm not really worried about that. So, and the market's pricing in that there's limited risk there. Moving on to the commercial market, that is now the hot topic. Last year was all about housing. You had this, articles about, the collapse of housing to come, and people have realized that's not happening. And so now it's all about the building I'm sitting in right now, office space. Office space is, top of mind. You had recent news of Blackstone, Brookfield, PIMCO defaulting on their loans. And I think that, this is going to be today's problem, at least for the next kind of year, is people thinking about what's going to go on with commercial real estate. And what doesn't help is going back to those regional banks. They're really big lenders in the commercial space. something like 39% of regional bank balance sheet is in commercial loans. Money center banks, something more like 7%. Now, part of it's like the big money center banks package up and sell these loans as bonds. But to the extent the regional lenders step back from the real estate market, it's also not helpful for the commercial real estate. Now, I can't say everything's in a bad spot. Industrial real estate, there's still demand for it. You've got e-commerce. Multifamily, while we're building a lot of units, there's still demand for it. There's relative underbuilding. It's really the office buildings that are kind of the tough spot. And so you're starting to see defaults pick up. It's a strategic default. The lender doesn't want the building. If I lent Blackstone money, I don't want to take over the office building. Blackstone also does not want to give me the office building. What they want is a better term on the loan. So they're going to go into what's called special servicing. They're going to renegotiate their debt terms. So I think that's going to give it's a headwind to the CMBS market. Spreads have already started to widen, especially after this kind of last couple of weeks with what's going on with the regional banks. So that's one place where on the margin, we're probably going to deploy less capital, I would think, into that market. CLOs, these are floating rate loans, bonds backed by floating rate bank loans. Another place where I think investors should be concerned. The cost of capital for borrowing in the bank loan market during like last decade when we were doing quantitative easing was relatively low because you could borrow at, let's call it LIBOR plus 500, and LIBOR was zero forever and ever and ever and ever. And here we are with short-term rates after tomorrow, maybe going up to 5%. So the cost of debt will have effectively doubled for people borrowing floating rate. That's somewhere where on the margin, maybe taking a step back or at least waiting for the market to reprice. And then as we go to consumer credit and asset-backed securities, I think higher quality consumer borrowers, higher credit score borrowers, I think I would stay there. I would avoid things that are subprime of nature, right? Subprime loans, being borrowers that have low credit scores, they're going to get hit first in an economic slowdown. And you can manage your risk in multiple ways. You can avoid certain sectors or stop allocating those sectors, or additionally, you could, what we call, go up the credit curve. Instead of buying, triple B bonds, you buy triple A bonds. So you buy higher quality bonds that are safer and will do better in those environments. So I think that's kind of what's happening now. Is the slowdown will increase in the economy. If we were, let's say, soft landing before, it's going to be less of a soft landing now. And so on the margin, I think credit spreads are biased wider in the near term, and investors should seek higher quality assets right now.
I want to dive a bit more into housing because you had a great guest column in Barron's. I think it was last summer, and you're right, a lot of folks had been calling for housing to just totally crater, and I'll let you kind of paraphrase your remarks there. I think you were talking about how like there needs to be some of that froth needs to be worked off, especially in some individual markets. But why do you think folks were so negative on housing? And I just want to hear more about, how you see it kind of playing out, like housing. You mentioned the supply to demand dynamics at play, especially like with millennials, and there's still. I just want to hear more on that, if that's okay.
Yeah, well, people like to get hits, and so it's sensational to say housing is going to collapse. And a lot of people own homes, they want to buy homes, so it's a fun topic to write about, right, or speak about in the media. So I think that's why you got a lot of these kind of sensationalist type headlines out there. But a lot of these people don't actually look at the data; they just look at the past and they say, "Oh, global financial crisis, that's going to happen again. Housing is going to collapse." But the supply thing has been building for over a decade. Like, we have been underbuilding homes relative to household formation for over a decade. So we're like multiple millions of units below what we need relative to, household formation. And millennials are the second largest generation since the baby boom, and they're hitting peak home buying age, which is like mid to late 30s, right? You had your first kid, you're still living in the city, everything is great. You have your second kid, you're still living in the city, it's feeling kind of tight. You have your third kid, you're like, all right, we need to go buy a house. Like, we got to get out of the city, we got to move to the suburbs, we need more space. And like that dynamic is happening. I see it a lot just with my own friends here in Los Angeles. And so that's the demand side. And the supply side is still in place. Now, there's places that had froth. There's places where, because of either a hot industry like tech, a hot city because of the demographic shifts that we're seeing from high tax states in the coast on the west, the Northeast moving to low tax states. Here, a lot of people, Angelinas, are going to like Nevada, they're going to Phoenix, they're going to Texas. The Northeasterners seem to be all migrating down south to kind of Florida, the Carolinas, and Georgia, like yourself. And so I think some of those areas also went up a lot in price. And so as I look to the corrections that we've already seen with nationwide housing being down about 4 or 5%, but then you go to Seattle, San Francisco, Austin, and Phoenix, they're down double digits from the peak. Seattle, San Francisco, Austin, those are clearly tech hubs. Austin's also one of the big places where you're seeing a lot of Californians go to, or just West Coasters looking for lower taxes. And then Phoenix saw a lot of building. There's a lot of land and desert, whereas you don't have as much space, let's say, if you're in kind of the Bay Area, right? So those areas are correcting harder. What's interesting though is the pace of the correction has slowed down in some of those areas. So I think maybe some of the tech pain in those tech regions, we've seen maybe some of the worst. Maybe we go down a little bit more, down 5, but I don't think we're going down 30, 40, 50 like some people are thinking about. Phoenix is really about the home building. So while there is a glut of homes nationwide, certain regions saw more home building. Certain regions also saw more of the iBuying from like the Zillows of the world and the open doors that were using computer algorithms to flip homes. Those areas that saw more building and that kind of activity still have inventory to flush. So as they flush the new homes that were built and they hit the new kind of lower bid, that'll take the market down a little bit in price. That inventory will get flushed, and now we're back to low inventory. So I think that's kind of what's happening right now. You saw this total collapse in housing activity, meaning, new home sales, pending home sales, mortgage applications. Everyone just said, you know what, prices are up. Rates went up, 300 basis points for mortgages. Let me just do nothing. Buyers thought the prices were going to come down a lot. Sellers wanted yesterday's price. Unfortunately for sellers, the price is lower. Unfortunately for buyers, the price is not down 20%. And people are saying, okay, it's been a year. I still need a house for my family. Rates have come down a little bit, and now you're starting to see housing activity pick up. So just today we got existing home sales, and it was, it's not up back to, let's say like 2 years ago levels, but it's improving. So I think there's signs of life in the housing market. Transactions are starting to pick up. Doesn't mean that prices won't keep going lower a little bit, but I think, we're not going to see that collapse that some of the, the doomsdayers were talking about a year ago.
Got it. Well, I apologize for the dog barking in the background, but when I was listening to your answer too, it was so interesting. Like you're pointing out, like, all the tech spending that went to these various cities, and I was one of the folks who got out of New York and hunkered down in Miami, Florida for a couple of years. And let me ask you this: like, do you think? I don't know if you want to call it like the great. I don't even know what folks call it, like maybe like the Great Migration. Do you think that is over? And what happens? I'm just thinking out loud here. Like, what happens? And I don't know if this is a scenario even worth pondering, when we've seen a bunch of like layoffs, for example, a lot of tech layoffs. What happens when folks who were those remote tech workers move to these different cities, they get laid off, but they have trouble finding employment that has kind of a similar salary in tech? Is that something you've thought about or have to think about?
Yeah, I mean, I think that some of those, it's like a lot of the mountain regions, like all the tech people went, they went to like Idaho and Montana and, go skiing and hang out in the wilderness. Some of those areas, like the local economy doesn't have jobs that can afford the prices of the homes there, right? So I think that to the extent they get called back to the office and you just can't work remotely, I think that some of those, high-flying vacations type home areas definitely come out a bit. But the Great Migration from expensive high-tax states to low-tax states with growing economies and businesses moving there, like Miami, I don't think that's over. And I think it's a powerful force. I was in Miami a couple weeks ago, and there is no recession on Brickell, right? I mean,
Yeah.
there's companies moving there. Citadel is building a big tower. It's just very lively, and I just feel like people are going to continue moving as some of the politics in some of these, high tax states just continue to move in the wrong direction for having a business there. I mean, California is one of them. We keep losing people, and they're going to Florida, they're going to Texas, they're going to the Carolinas. I grew up here. I love the weather, don't love the taxes. At some point in time, I've thought about it. I've talked to my wife about it. We've got family here, we've got kids in school, so we're not going to move yet, but I think it's on everyone's mind, really.
How about, I would just want to bring this up to you. It seems like in recent years, there's been a lot of like institutional buying in housing. How do you think about that?
Yeah, there's been two kinds of institutional buying. One is the single family rental business, which started during the global financial crisis, when like the Blackstones and the Colonies of the world raised money to go buy single family homes and rent them out in mass. Mom and pop has been buying single family homes and renting them out. It's a tale as old as time. People have rental properties, but it was never institutionalized until after the GFC. Investors thought that you couldn't scale it because of the high fixed costs associated with trying to manage a bunch of different properties as opposed to having all these units on one building, right? Like a traditional multifamily unit. But as it turns out, if you scale it enough, which these big operators have done, that it can be a profitable business. Now, they were chasing a lot of assets as they saw a lot of money come in. They're raising money in like the private equity world, and they're going out and they're spending it. And so I think they all took a step back, all worried about home prices coming down. But we've anecdotally heard stories of them kind of stepping back into the market now that we've seen a little bit of repricing. Now, the doomsdayers from last year, they pointed to those institutional buyers saying that, like, if they stop buying, it's over for housing. They're such a small percentage of the float of actual buying that it doesn't really move the needle. Mom and pop are the largest single family rental buyers out there still. So the next institutional buyer is the iBuyer, right? The technology-based buyer. Opendoor and Zillow were two of the big ones. Zillow shut that business down. It was like 2 years ago, maybe a year and a half ago. They kind of went crazy in some of these kind of southwestern markets like Phoenix and Nevada, mainly Vegas, where it was easy as the computer algorithm does really well when houses are really homogenous, right? When it's like cookie cutter tract homes that were built, they all look the same, like one unit to the next, like you just know by square footage, this square footage trades at, $400 a square foot in this neighborhood. And so the computer algorithm could be pretty good at buying that. They went crazy. It worked when home prices went up, and once home prices went down, it stopped working. So I think a lot of that activity has kind of gone away. And so I think that really it's those institutional single-family rental buyers, the big REITs, the Pretiums of the world, and they keep raising money. And I think it's a feasible business model now. I was negative after the GFC. I didn't think they'd be able to scale it, but they proved me wrong. And they took a step back, but I think that they still have demand, and that'll help create kind of a floor in certain areas as they come back into the marketplace when home prices do correct. So I think that's another competition for the millennials that were having problems buying before all this went down, and they're still having problems buying. There's just no inventory. I mean, if you're out there and you're looking for a home, I'm sorry, because we like to go on Redfin and look around, and we see the lack of inventory out there.
That is so true. I can tell you, like, there's one neighborhood that I really want to get into in Raleigh, and every time I'm talking about, the tiniest little house will pop up and it will sell like that weekend for a ridiculous amount of money. So there's a lot of competition.
Location, right? Like that's the
So
thing they
true.
say about real estate. There's certain pockets that people want to be in, and there's rarely a home for sale. So if a home finally pops up, someone's going to just pay that premium to be there. And that's why the desert states right now have the are declining a lot because there's so much land that you can build, constantly build out, that there's just a lot more units that potentially can come to market. There's so much more space, right?
Yeah. When you mentioned too, like when we're talking about housing, like this underinvestment in terms of new construction for some time now, why is that?
I think labor costs were up, material costs were up, and so I think a lot of builders focused on like higher end homes, right? They can they can spend the same amount of time building a higher end home in a more expensive neighborhood, and a lot of them just focus on multifamily too. So multifamily is kind of on the opposite end. We may have a little bit more supply than we need in multifamily, which I think will actually help the Fed out and push rental prices lower. But it's not so much I'm concerned about, the same oversupply we had in the GFC. So I think that, home builders took a step back because they thought prices were going to fall, but you're actually seeing permits pick up again. I think the correction in prices, and then they're watching the mortgage rates come down a little bit, and they look at the undersupply and they realize, okay, maybe let's not build as rapidly as we were, but this is still a viable business for us to make money. And your home builder stocks have recovered. And I think home builder activity is, come off the lows, if you will.
I want to hear more about just the work that you do, overseeing the non-agency RMBS team, specializing in investing in non-agency mortgage-backed securities, residential whole loans, and other mortgage-related opportunities. And I don't know how in-depth you want to get, but can you kind of just walk me through it? As if I'm new to it. I want to hear more. I just want to learn and maybe kind of get into a bit of like the plumbing, if you will.
Yeah, well, if you think about the mortgage-backed securities market, it was started a very long time ago. Prevalence really grew in the 80s. And back when it was first started, it was all government guaranteed, right? We had these entities, Fannie Mae, Freddie Mac, Ginnie Mae. Mortgages would get made, they would get packaged up, guaranteed by those entities, and then sold with a slight yield pickup over treasuries. And your only risk was prepayment speeds, which means like people can refinance. And so the risk in an MBS is really, you just don't really know when you're getting your money back. When you buy a corporate bond, it's got a maturity date, you got a semi-annual coupon, you get your coupon every 6 months, and then at the maturity date, hopefully you get all your money back if the company doesn't default. And so there's this concept in the MBS market of, through time, interest rates move up and down, prepayments change. And so I don't really know when I'm going to get my money back. And for that uncertainty, I need to get paid more spread. And in the 90s and 2000s, the prevalence of what's called non-agency mortgage-backed securities grew. And so instead of just packaging up these agency loans into these agency bonds that are government guaranteed, so you don't have any default risk if borrowers miss their payments and go into foreclosure, they started packaging up other loans that were maybe held on bank balance sheet that didn't qualify for Fannie, Freddie, Ginnie Mae. And so they call them non-agency instead of agency. And here you still have that prepayment risk. Borrowers can refi on you at any time. But now you have the additional risk of, if the borrower defaults, you're subject to that credit risk. So if they default, you have to go through foreclosure, potentially sell the house. You could take a loss on the house. So now I'm exposed to losses. So when we analyze investments, we're still analyzing prepayment risk, just like you had to in the 80s and 90s, and even today on those agency mortgage-backed securities. But now there's this additional risk of credit losses. And because of such high losses during the global financial crisis, there's a lot of investors who are always skeptical about our market. But in some ways, because we went through the global financial crisis, things are so much safer now. The credit quality of underwriting is so high, like average credit score, like everyone in the US has a FICO score, right? You're probably super prime, 800 FICO, hopefully. A subprime borrower is, like a 600 FICO, call it. And so we look at things like the borrower's credit score. We look at how much money they put down. You have to put 20 to 30% down. In 2006, you can put 0 down, right? So this is a big difference. People have skin in the game. And the rating agencies that, determine how to make these bonds AAA, AA, or investment grade, they're so much stricter now since all that bad stuff happened back during the global financial crisis. So it actually makes, I think, our market in some ways safer now than it was before, since we were the heart of darkness during the GFC. So as investors, we're looking at the prepayment risk, we're looking at the borrower characteristics, what their default risk is, and then we try to model out, if a loan defaults, what will the loss be? And so we look at a lot of loan data. It sounds kind of boring.
No, it's actually interesting.
Yeah, for what's funny is it's in some ways it makes things easier for us because we can leverage data, right? We have millions and millions of loans in the past that have like gone through different economic cycles, and we can see how they behave. Where if you're on our CMBS team, you know, they have to like roll up their sleeves and go look at each loan. Each loan is backed by a different building. It's in a different city. You know, one side of the train tracks versus the other side of the train tracks can be so different. So it's a much more manual, hands-on investment decision. You could have the same building and two borrowers, and one borrower could be a great borrower with a ton of money and, you know, well-capitalized private equity firm, or it could be somebody that has like a history of litigation that's constantly suing their lender, right? So who do you want to lend money to? The well-capitalized private equity company, or the, you know, the person with the speed dial to their lawyer to go sue everybody? So it makes analyzing commercial real estate a little bit more idiosyncratic, loan by loan by loan, location by location by location, whereas we can kind of leverage big data, and we've got really, you know, bonds that are backed by thousands and thousands of mortgages nationwide. We're really, really diversified. And so, you know, we spend a lot of time looking at the housing market, looking at the state of the economy, because that's going to drive unemployment and people's ability to pay mortgages. And, you know, I think that even if we do go into a recession, which seems more likely today than it did 3 weeks ago, that the fact that there's so much equity in people's homes is going to limit defaults. And then we created during the pandemic these widespread forbearance programs where a mortgage borrower can miss payments. You take their missed payments, you move them to the back of the loan. You know, they get another job, you get them paying again. Is it right or wrong? That's up for debate, but it worked. And I think that we'll use forbearance programs again, and that's going to really limit losses in mortgage credit. So we're bulled up on the credit performance. I'm not necessarily bulled up on the entry point. I think, again, spreads across all credit markets are probably biased wider given the volatility out there. But I think, you know, as they widen, it's mortgage-backed securities offer a lot of compelling value.
That is fascinating. And just like a couple of takeaways, like any of those new loans issued since the credit crisis, they've been underwritten with a lot of discipline, as you point out. And you're just mentioning like you can leverage that big data. I was wondering maybe if you're willing to, if you could provide a bit more insights on non-agency RMBS and the outlook, because I would love to hear more about the views on the credit quality of non-agency RMBS, the performance, you know, during different market cycles, the potential risks and rewards of investing in non-agency RMBS.
Well, it's tough to say because the economy since the GFC has been in a world of zero interest rates, and housing prices have really only gone one way but up. And we had one recession, which was, you know, in 2020, which lasted, I don't know, a couple of months until stimulus checks and QE kind of bailed us out. So thus far, the performance has been really good. There's only been something like, I want to say like 90 loans, not even, and maybe less than that have had a loss out of like, you know, half a million loans that have been originated. So there's some crazy statistic of just like there's no losses in the market. And part of it's just that home prices have gone up. If you put 20-30% down and then home prices go up, you're not going to default and take a loss. You're just going to sell the house, take your money, and walk away. And so that's why the losses have been so low. So I think that the money down, the low LTVs, the conservative underwriting, I suspect that we will see low losses on a go-forward basis, even if we see home prices decline kind of 10-15%. What's maybe more interesting than non-agencies today is actually agencies, since they were so boring for like the last 10 years. the Fed was buying agency mortgages. The spread was really tight. Rates were low, so the yield was really low. They just got killed last year because the Fed stopped buying them. All those regional banks like SVB that loaded up on MBS, they stopped buying them. They maybe even be selling them right these days. And so agency mortgage spreads are 99th percentile over the last 10 years, meaning the spread on them has only been wider 1% of the trading days over the last 10 years. Government guaranteed. The spread on what's called current coupon mortgage-backed securities, which is the bond that's trading closest to par, which is backed by the kind of loans we're making today in the marketplace. That's at like 160 spread to treasuries, which is wider than corporate credit. It's got no credit risk. And the prepayment risk of the MBS market is so low today, since everyone, hopefully, is in these really low 3% coupon mortgages, and mortgage rates could fall 100, 200 basis points. None of these people can refi. Everyone's in such a low coupon mortgage. So I think that's one of the more interesting places in the bond market. We really haven't talked about it here at DoubleLine in a long time because it was nothing to talk about. The Fed was buying it, the spreads were tight, the risk was high. Now the spreads have widened, the risk is lower, the yields are higher, and they do well in bad times. They do well in recessionary environments relative to credit assets. And so I think that's kind of one of our highest conviction ideas right now is agency mortgage-backed securities. There could be some near-term volatility with all this stuff going on with the banks and the financing. But I think, if things continue to deteriorate economically outside of treasuries, which will do the best, I think that agency mortgages are an interesting place for investors to look at these days.
Yeah, an interesting place. And I'm learning a lot from you too, just having this conversation, because it's not something we haven't really covered it. We have not covered it on this show. I know that. But it's just fascinating to like learn from different parts of the market. And you mentioned like near-term volatility. Can you talk to me about, what happens? We'll have the Federal Reserve meeting tomorrow, so we'll find out if they hike or if they pause. But how is it impacted by interest rates?
Yeah, so I think the bond market 3 weeks ago was pricing in a high probability of 50 basis points move, right? And what's happening with the financial system, with the concerns around the banking system, rates have fallen, and now the market's kind of pricing in maybe a 25 basis point move by the Fed. I think to save face, because they got so hawkish at the last meeting, and the fact that the ECB moved 50 basis points, I think that they're probably going to do 25. They either do 0 or 25. 50 is totally off the table. And I think in the near term, rates kind of got ahead of themselves. There was this panicky rally in the treasury market, and we got down to, very low levels across the curve. We've backed up a lot from the lows, which was, I think, yesterday morning. And I think there's a little bit more room for interest rates to rise as kind of market realizes, inflation's still here. Maybe the Fed's not, going to cut. I think they hike. They may not cut, but they're going to keep rates up at these high levels, which I think continues to, contract the economy. And I think it gives maybe another buying opportunity for treasuries. A lot of investors have been hiding out in the T-bill market, rightfully so. The yields have been really attractive. But at some point, you need to lock in a little bit further out the curve because you want that protection that you get with longer duration treasuries. They go up in price when rates fall. The T-bill is not going to go up in price. So I think, we saw the high-end rates this cycle probably in October of last year. We got to about 430 on the 10-year. We revisited that 4% level, last month. A lot of people may have not bought them. And so if we back up here, I think don't get too cute. If you have been running short duration in your portfolios, I think it's time to add some duration given the risks out there. And I think, I've been telling investors, you may not get a third bite of the apple being that 4% 10 years. To the extent we get higher from here, I think people should, start adding some of that duration exposure into their portfolios.
Yeah. Well, as we've pointed out on this episode too, like, DoubleLine is known for structured products, which of course includes non-agency RMBS. So what other kinds of paper do you look at?
Well, we look at those commercial mortgages, we look at those CLOs we talked about earlier, and asset-backed securities, which is basically anything not a mortgage or a CLO. It could be backed by credit card loans, auto loans, student loans, timeshare receivables. Any receivable can be packaged up and sold to that ABS market. And that's been an interesting market. It's really developed through the years. You go back 20 years, it was really driven by credit cards, auto loans, student loans, just like your on-the-run commercial loans that most banks make. And through time, companies have realized, hey, like I sell corporate bonds to finance myself, but I'm actually generating this asset. Maybe I can sell a bond backed by that asset and get better financing than I would in the corporate bond market, or at least diversify my financing sources. So you've seen that market really develop through time.
Do you all also use do you leverage big data for those sorts of asset-backed securities?
Yeah, I mean, anywhere you can get data, consumer credit data, there's tons of it out there, so that we can leverage. Even on the CLO side, we can get a lot of historical bank loan information, defaults, historical defaults on bank loans. We can get daily prices on all the loans that are inside those CLOs, and so that helps as well. It really just goes back to my commercial team. They've just got to roll up the sleeves and look at the properties. I mean, they go and they visit the properties. They're on Google Maps, just like looking around the neighborhood and seeing kind of what's out there. So that's still a very kind of like hands-on brick and mortar type kind of investment process. And you need to, because you're along these buildings and you really want to go and almost like walk around the area to kind of feel the energy and feel kind of the vibe of those neighborhoods. And if you go walk around downtown LA and you want to land on an office building, it's not feeling pretty good. It's not feeling that good these days.
It's not feeling good these days.
Downtown LA. I mean, I was just in New York, and I don't know, New York feels like it's come back a lot.
Yeah.
And especially around Midtown, but downtown LA is still kind of a ghost town. So it's kind of sad. I went to school around here, and I saw the revitalization of the city after they put in Staples Center, and then they started developing the artist district and more housing developments and whatnot. And COVID just put us back, like it seems like 20 years.
Wow.
So it's sad to see, but unfortunately, there's like a lot of vacancies here. I'm looking out the building at the office tower next door, and there's a lot of lights not on right now, right on a Tuesday during the middle of the week. So we'll see what happens with office space over the next year. I think that's one of the places to watch.
Do you have like a pulse of other markets just from like the on the ground work that you all do?
I mean, there's a lot of Class B office in New York that nobody knows what's going to happen with it. Somebody could give you the building for free, and the numbers still may not pencil out if you were going to convert them into condos and try to rent them out, right? DC is struggling. I mean, just Chicago, San Francisco. It's like there's a lot of these big cities that there's a lot of office space, and it's bifurcated, right? Everyone wants to be in that brand new building, has all the amenities. Those are doing fine. But like that Class B office space built in like the 80s, crappy elevator. We all know the building I'm talking about.
Mm-hmm.
Like that's just, nobody wants to be in there anymore. I mean, those are really going to struggle. So I think, and some of those loans, maybe the regional banks own them. So it's a part of the economy that I think I'm concerned about. Office space specifically. I think multifamily industrial is probably fine. The market's already sniffing it out, right? You look at some of these REITs, they've already gone down a lot in price. The CMBS bonds that are backed by these big office towers are already pricing in much wider spreads. So, but I think it's coming to the headlines. Like nobody was really talking about it last year. And now that you're seeing kind of big name money managers default on loans or bonds, it's started to, hit the top go, if you will.
Yeah. Well, Ken, I feel like I've learned a lot from you. I want to give you a few moments for any parting thoughts, anything that I didn't bring up in this episode that I should have. And also if you want to let folks know where they can find you, watch Channel 11 News, your own webcast, please take the next few minutes to do so.
Sure. We covered a lot. I don't know what's left to cover. I would say that, I think there's a lot going on in the economy. The stock market is feeling like things aren't that bad. The stock market may be wrong. So I just say, as a individual out there, right now is probably not the time to take huge risk. Be conservative, wait for a better entry point into risky assets. And, if you're in some of those regional banks, maybe think about moving some of your money to the money center banks. Just kind of play it safe right now is a good game plan. But outside of that, you can find information about DoubleLine on our website. And I host a YouTube show, Channel 11. Come check it out. And thanks for having me on. It was really nice catching up. And I hope you guys are enjoying Rally.
Yeah, well, likewise. Thank you so much, Ken Shinoda. Really enjoyed having you on the show. Thank you so much for being so generous with your time and your ideas. Really appreciate you coming on.